Hello everyone. So this presentation was made for English Culture for Business 2, and it's about the Bank of England, and it's going to be presented by Beatriz Silva, Bárbara Sá, Cláudia Santos, and Rita Mota.
Regarding the topics that are going to be presented throughout this presentation, we will be discussing and giving an historic overview of the Bank of England. That is to say, we are going to explain the origins of the Bank of England and how it came to be. After that, we will be giving a simple explanation of what exactly is the Bank of England and how it works. We will also clarify its structure and responsibilities. So we will be explaining the functions of the Bank of England. And as a final topic, we will be talking about the BOE and its link to the government and the Brexit, and we'll also give a fundamental analysis.
So to give you some context, that this first part of the presentation is going to be about the historic overview of the Bank of England. So the bank was founded in 1694, and it had two main goals. So the first one was to be the banker to the governments, and the second one was to help fund the war efforts for the English army that was fighting against France in the Low Countries. So basically what happened was that the king and the queen at the time, William and Mary, that were the two original stockholders of the bank, they created a royal charter. This royal charter allowed the bank to operate as a joint stock bank, which basically meant that the bank was owned by its investors, and each investor owned a share based on the amount of the stock they purchased. The bank at this point had a limited liability. In this charter, it was also explained that the bank was founded to promote the public good and benefit the people. This basically happened, the creation of this bank basically happened because the government coffers were depleting at a fast rate after the defeat of the England in the war. And so the country had to find new institutions to borrow money and to finance the national debt. So that being said, following the enactment of the Bank Charter Act in 1844, under the government of Robert Peel, the bank got monopoly power on the issuing of banknotes, both in England and in Wales. And this was a significant step towards becoming the official government bank. What this bank charter meant was that it gave the bank the sole right to issue banknotes, except for a few smaller banks, but they had to be headquartered outside of London. So after the 1997 general election, the Chancellor of the Exchequer announced that the Bank of England would be granted independence over monetary policy. By that time, the bank had already become the largest and the most prestigious financial institution in England, and its banknotes were widely circulating. As a result, it became banker to other banks, which, by maintaining balances with the Bank of England, could settle some debts among themselves. The bank was only threatened by the economic instability that was brought by the French Revolution and the Napoleonic Wars.
So, what exactly is the Bank of England? The Bank of England is essentially the central bank of the United Kingdom and is actually the model on which most modern central banks have been based. It was established in 1694 to act as the English government's banker, and it's the world's eighth oldest bank. It was privately owned by stockholders from its foundation in 1694, and it was nationalized in 1946 by the Attlee Ministry. and it finally became independent. It became an independent public organization in 1998. Um, the Bank of England is one of 8 banks authorized to issue banknotes in the United Kingdom, and it also has a monopoly on the issue of banknotes in England and Wales, and it regulates the issue of banknotes by commercial banks in Scotland and Northern Ireland. The mission of the bank is to promote the best of the services to the people of the UK by managing monetary and financial stability. This is done by keeping stable the cost of living and installing on the banking and payment services. The work is governed by the Court of Directors, and it makes strategy and important decisions that is beneficial for the economy. The Bank of England is funded by charging the fees, by providing services to the customers through central banks across the nations, and by charging a cost of issuing banknotes.
So when it comes to the structure of the bank, it's comprised by the governor that is elected within the bank, holds the most senior executive position, and participates in all the committees. Then we have the Court of Directors, that is the main administrative body and oversees the bank's operations, strategies, and resources the allocations, and is elected for 5 years. Then we have 3 subcommittees. They are the Monetary Policy Committee that implements monetary policies and sets the interest rates. Then we have the Financial Policy Committee that ensures the stability in the financial system. And finally, we have the Prudential Regulation Authority that regulates the financial industries. Then, for last, we have the 16 board members, where 12 are responsible for big companies in England. 4 of them are part of the staff, and they are elected for 3 years.
Regarding the responsibilities of the Bank of England, there's no better way of saying it that the functions that are required of the Bank of England are actually pretty numerous. As the top monetary and financial authority in the United Kingdom, the Bank of England assumes the role of guarding the well-being of the British economy as well as the financial system. And so, the Bank of England primary responsibilities are overseeing the national economic health, as said before, issuing banknotes, planning and executing monetary policy, implementing economic interventions, regulating and ensuring the integrity of banks, acting as a lender of last resort in financial matters, and have a custodianship of the gold reserves in the United Kingdom. Additionally, it also controls inflation, ensures the purchasing power of the national currency, and the stability of the exchange rate.
Concerning the Bank of England and the government, the Bank of England is the central bank of the United Kingdom, and it's a model on which most central banks are built. Since its inception, the bank has changed from being a private bank that loaned money to the government to being the official central bank of the United Kingdom. Although the Bank of England is UK's central bank and is owned by the United Kingdom government, they have specific statutory responsibilities for setting policy, such as interest rates, financial stability, for the regulation of the banks, and for insurance companies. These are carried out for the good of the people of the United Kingdom within a framework set by government, but free from day-to-day political influence. As I mentioned before, the Bank of England is owned by the UK government, but it is still independent from the UK government. This is that the UK government appoints all of the bank's senior policymakers, but the Bank of England has independence from the own government in terms of how they carry out their responsibilities. And how does this work? Well, for example, the Parliament has given the bank very precise goals and responsibilities. For each one, they have specific tools that they can use to meet their objectives. The Bank of England has committees that make decisions about other responsibilities, such as making sure the financial system is working properly to serve UK households and businesses. As a result of the United Kingdom referendum on June 23rd to leave the European Union unleashed a shockwave through the whole global financial markets, the measures of financial stress had almost recovered to their pre-referendum levels in the rest of the world. This heightened the volatility that continued to dominate in Europe and in the United Kingdom in particular. Indeed, Britain's decision represented a major political and economic shock to Europe as a whole. The negative economic effect is likely to be concentrated in the United Kingdom, but will have important ramifications for the rest of Europe, and especially the Eurozone. The Bank of England said it was ready to tolerate an inflation spike in the event of a no-deal Brexit in 2 weeks' time, but kept its stimulus unchanged as Britain and the European Union entered the whole negotiations. Despite the Brexit, and according to Global Financial Centers Index in 2021, London still remains the world's second biggest financial center behind New York when infrastructure, reputation and business environments are taken into account.
The UK is influenced by the Bank of England in its interest rate decisions and the Monetary Policy Committee economic interventions. This committee meets 8 times per year to evaluate the GDP, inflation level, and unemployment. The committee is free to use the necessary tools to put the economy on track when it's far from the regular situation. Their main tools are interest rate decisions, asset purchase facilities, and minimum reserve requirements. The Bank of England can have an interest rate hike when the economy is going too well, or an interest rate cut when the economy is underperforming. If the economy is superperforming, it can occur an increase in the unemployment levels due to salary increases. On the other hand, when the economy is underperforming, the employment rates tend to increase. How is it possible to trade the Bank of England decisions? Bank of England interest rates decisions by the MPC have strong implications on the values of the British pound sterling, the stocks traded in the London Stock Exchange, and the UK government bonds. The meeting of the central bank are anticipated by trading news, and there are valuable information shared with the population, as well as future expectations. If the decision is to decrease interest rates, the GBP and the bonds will lose value, while stocks and possible commodities will rise. If there is an increase on the rates, it will happen the inverse. If any anomaly happens, the market reaction will depend on the expectations towards the measures that the Bank of England might take. Big investors always depend on the Bank of England expectations for the future in terms of British economy shaping.